Well, our next guest says that Warren Buffett's optimism on the markets is, quote, fool's gold. Joining us now is Charles Ortel, Managing Director of Newport Value Partners, which provides independent investment research to professional investors. Charles, thanks for joining us.
Thanks for having me on.
In a recent article, you said that Warren Buffett was, quote, selling fool's gold to the retail investor. Explain what you mean by that.
We like to tear apart companies to try to understand their core intrinsic earning power and cash flow generating capability. And when you do that, you do not come away with a sense of optimism that Warren Buffett projects to the retail incurious investor. Revenues in a lot of these companies have come in short of expectations. Revenue trends for the big companies we follow are not on a growth tear from 2010. And cash flows and free cash flows for these companies are actually down, and disturbingly so. So a lot of what's driving the market action since March of 2009 has been coordinated central bank activity suppressing interest rates. We don't think the central banks can do that for much longer.
You make a very valid point. Of the earnings season that we've had so far, only 42% of companies have beat on revenues, on the sales number. The others have beat on earnings, on income, which can be more manipulated due to cost cutting. There's a 1% decline in revenues. Explain that in simpler terms to our viewers, why this is a big concern.
Well, it's like any household. If your annual income in the household goes down, but your savings, let's say, go up, what you have left over at the end of the year is slightly better, do you really feel good about that? You know the big picture. The money coming in your front door is shrinking. And typically, most households are growing each year. They might have new children or new responsibilities, et cetera. So it's not been a good trend since the 2009 period, the depth in America of our recent problems. And this is with all the fiscal stimulus and all the monetary easing, which should have, in theory, improved things more.
Yet the market's ignoring all this. When do you think we'll see a pullback? If we'll see a pullback.
Well, I think the retail market is ignoring it because the retail investor has so few options to get any kind of a yield on his or her savings. So foolishly, a lot of these retail investors are saying, well, you know, I don't like the CD yield on my bank account. I'll take a dividend, not appreciating how risky it is to own common stocks.
So again, it's a recurring theme that we've had the lesser of all evils. The bond market's not offering anything. Commodities have been very volatile. So retail investors are going into the markets. So would you advise retail investors to not be in the market right now?
That is absolutely what I would advise. I mean, the function of the regulatory bodies and the government agencies should be to help retail investors stay away from the markets when they look particularly frothy. The professionals, experts I know around the world have been out of the market for a while, and if anything, they're short.
So being short, being a bear, do you foresee a crash, a major pullback? When do you think this will happen, and what would cause that?
Well, there is a series of geopolitical flashpoints that could very easily, any one of them, tip us back to the place we were in late August, early September 2008. We have been saying since then that the underlying structural conditions in the global economy are actually worse and have been compounded by the efforts of these governments. So we believe that when the crash comes, it's going to be worse than 2008, worse than 2009, could even be worse than 1933.
And you're saying the central banks around the globe, they're the ones that are creating this because we're kind of repeating the same thing that we did in 2008 by pumping more and more credit, well, before 2008 rather, pumping more and more credit.
Well, I would encourage your viewers to go on the Federal Reserve website themselves. They publish financial statements, and if you look at the ratios for our Federal Reserve System, which is the world's biggest central bank, the ratios are very thin indeed.
Okay, so what can I do? I'm a retail investor. I'm listening to you, sounding very gloomy and doomy. What can I do?
Well, I have been pushing gold, and on when we see actions in the futures markets that depress the paper price of gold, I think you see a stampede weeks later when the figures were reported, I believe, in Hong Kong just recently.
You mean the hard asset
Physical
gold? You're talking gold bullion,
bars.
gold coins, gold bars, gold jewelry.
Yeah, we advise our investors, and we are bearish, but we advise them to have a third of their portfolios on December 1st, 2011 in physical gold. Very few people have that much in the way of physical gold. But I think that's one smart place to have your money. You can keep it in your apartment typically, or you can keep it in a bank vault. You don't have to read financial reports to figure out all the complexities of equities. You just can sit on a big, nice pile of shiny gold.
Gold bars under my mattress. I don't think that's necessarily a bad idea, and I think a lot of people are doing that. And you may prove us all right or wrong in the end. Thank you so much, Charles Ortel, Managing Director of Newport Value Partners.